Hello fellow traders, 'tis I, the Rumpled One. In the last video I posed a question. If price doesn't change when you change time frames, why would you use an indicator that changes when you change time frames? One of the reasons I posed that question was a email newsletter that I got from Sam Seiden. Yeah, like I said, I've got nothing against Sam. He's got a good reputation. He's got some good tips, but sometimes I think Sam misses the mark. In this case in particular, he talked about system trading and how, over the past 2-3 decades, we've seen a lot of changes, with the advent of the PC and online trading and now high-frequency trading. A lot of things have changed. And then he talks about the most important aspects of a system. And he talks about, the key to proper trading all comes down to the foundation of the strategy. And there's nothing wrong with that statement if you just hear it like that, slightly out of context, but it does stand on its own legs. But if you read Sam, you study, he's all about the concept of supply and demand. But once again, it's a concept. And he goes on to talk about, who's on the other side of the trade. It's kind of like when you go to a poker game, if you don't know who the sucker is, then it's you. So then he talks about, charting and technical analysis. And he shows one little system, where he takes a 50-period moving average. And then he also uses stochastics indicator. Well, we all know both of those are squiggly line indicators. And when you change the time frame, those values change, even though the price doesn't change. So that's why I posed the question. Because I even wrote a couple indicators based on his system, just to take a look at it. Sure, you can have profitable trades. I won't deny that. But the point is, if you look at it on the daily time frame, it might be telling you to buy. But if you look at it on the 1 hour, it might be telling you to sell. So it's confusing. Why would you use an indicator that if you switch time frames, which is nothing but data compression, how much data are you looking at and how are you slicing it anyway? I mean, there's no magic. There's no secret numbers. I mean, I know I've got some buddies that have the secret MACD numbers or the secret stochastic numbers or the secret moving average, numbers and type. That's all hocus pocus. See, I got another email, and it talked about training versus reliance on secret techniques. Now, Sam is saying, yeah, you need the proper training. But the thing is, these techniques, though, aren't secret. I mean, as traders, we know what we need to do. We all know it. But the problem is that in the heat of the battle, we sometimes fail to do what we need to do. And that's part of the psychology of trading. Trading in the zone type of talk. But the thing is that unless you just do it, you make those better decisions. You hold off on clicking that entry trigger because you know that it's not a good one. You know it doesn't meet your criteria. You don't second guess your system. You follow it. Sam says the same thing. It's just, like I said, with these squiggly line indicators, it just doesn't make any sense to me why you would use them when you can use something that's the same on every chart, like the open price. Same on every chart. The daily open. Doesn't matter what time frame you use, it's the same. Last week's high and low. Doesn't matter what time frame you look at, it's going to be the same on every chart. The current high and low. for the day. Same on every chart you look at. So I really don't understand why indicators that change based on time frame got to be so popular. It doesn't make sense. I mean, if you really think about it, you take a day's worth of data and then you run a moving average on it. Depends on how thin you slice it. What do you think? There's some magic number that if you use 50 as opposed to 55 or 45, it's better? It just doesn't make sense. And that's one of the reasons why I got booted off a bunch of trading forums, because I went up against, you know, the typical trading teachings. I said, no, it doesn't make sense. Hey, in the beginning, yeah, I did multiple, you know, period indicators where you could look and see, but then I realized, no, these things, they really don't work. They're misleading you. You're being fooled. When you could just open your eyes and look at a chart, I don't need an indicator to tell me that price is low. I mean, there's no indicator that's going to, you know, tell you about the buyers and the sellers and the orders pending. It just doesn't exist. And you're not going to win trading that way. It's just not going to happen. Now, the funny thing is that Sam says, you know, he doesn't really use these squiggly line indicators. You know, he looks at a chart and marks it up in, you know, supply and demand areas. But he says that, you know, these indicators, they usually trigger right around the same area. But see, to me, once again, that whole concept of supply and demand is going to change when you change time frames. Because one time he'll put up an example, he'll be using a 15-minute chart, and another time he's using a daily. Well, why isn't he using the same one? You know, he says, I guess he's saying the concept can be used, but if I'm looking at a 15-minute and it says it's in a demand zone, but then I look at a daily chart and it's just like, no way, this is still coming out of supply. What do I do? It's confusing. So, fellow traders, just have to be aware of these things, because it's not what you trade, it's how you trade it.